Welcome to the Big Skinny. Yeah, I knew it was coming again. It's getting predictable. We don't want to be predictable because here at the Big Skinny, we bring you the latest breaking market news that matters. And you may be asking yourself, if you've never tuned in to one of our 9 episodes before this, what the heck is the Big Skinny all about? Well, let me tell you what we're about. According to Urban Dictionary, the Big Skinny is all about insider information. We don't do that. We don't like to end up behind bars. But what we do is give you information that is essential to survive and thrive in these crazy markets. We got a Moody Monday in the markets this week. What do you do? What moves do you make in your portfolio? Well, we're here to tell you all that and do it in a fun and engaging format. I like to think of us like Dave Portnoy for pizza reviews, but for financial and investment news. You know Dave, he always takes one bite. Everyone knows the rules, and everyone knows Dave doesn't ever just take one bite. So we're going to give it to you in a similar format. We're going to give you one headline that you should most likely ignore. We'll follow that with one chart that reveals really key data that will give you the courage to be a contrarian in any market. And then we're going to give you the action to take. One investment insight that tells you what to do to go against the mainstream and to go in line with that data to, well, increase your bottom line, to make money in these markets, because that's what we're here for, right? I could be entertaining and engaging, but if we don't make money together, you tune out and I'm out of a job, and we don't want that. So we're going to do that every week. We want you to join the conversation. Yes, I did. I said do, and we do comments here, biting criticisms, stock recommendations, whatever you fancy. You could change the direction of the show if you were a child of the 90s, the 80s and 90s. This is a choose your own adventure show to some degree. I have full editorial control at the end. I may ignore you and shun you, but I won't make too much fun of you. But anyway, whatever platform you're joining us on today, please do not be afraid to chime in at any time. We're going to run through what I bring up at the top of every show, 3 critical topics that are in our rundown that you need to be paying attention to before we welcome our first market guest. But before we get to our guests, let's get to those things that matter. This week's rundown. Well, folks, I got it. You see it here. Liar, liar, pants on fire. Someone is absolutely lying. You know, the headlines, probably the headline's lying, but someone else is lying too. What am I talking about? Well, if you've been paying attention to any of the financial media over the last 3, 4, 5, 6 weeks, we've been hearing that all these economic alarm bells are ringing everywhere. Recession is afoot. It's just around the corner. The consumer's going to crater and stop spending. And what has it all been based on? What I call soft data, right? It's sentiments, it's surveys. And here we give a shout out to Mike Cantro, showing that how people feel is not really reality. If the consumer in particular, their expectations of inflation in the last survey, they expect inflation to be at 6.5% a year from now. Completely out of touch with what's happening with inflation right now. Maybe some fear over tariffs. But if you look at their expectations for inflation over time, it never matches up. So soft data, sentiment, feelings, surveys don't really matter. What matters is don't bet against the consumer. I mean, if we look at the actual hard data, consumer spending, annual consumer spending here, folks, squint your eyes and try to find the downturns. There aren't many. There was one after the great financial crisis and a little blip after COVID, but that's it. If you get into this is annual data. If you look at the quarterly data, there has never been a time where we've had more than 2 quarters of declines in a row. So whatever you say, don't bet against the consumer. Don't tell me the consumer's overstrapped, over-leveraged, and can't afford it. If you look at this chart, the facts are this. Consumer balance sheets have never been in better shape. We have 10 times the amount of assets than we do liabilities. This is historic territory here. The consumer can keep on spending despite what you hear in the news. Now, I'll be the first to admit, does this mean everyone is enjoying salad days and has plenty of extra money to go around? Absolutely not. I don't want to be out of touch, right? Prices are up. Eggs in New York, still outrageous, $12 a dozen if you get those farm fresh, pasture raised. I don't know what they do, sing lullabies to them at night. They're expensive. That's all I know. But here's the fact of the matter is even after all these price inflations, we are making wage gains that can offset the inflated prices, and we're in a lot better shape than we were going into the financial crisis or going into COVID. So what's the big takeaway here? Liar, liar, pants on fire. Consumer sentiment plummeting near record lows, but consumer spending, lo and behold, is at a record high. Personal consumption at a record high. So consumers don't do what they say they're going to do. Their sentiment and they're feeling bad about the economic outlook, but they keep buying. And folks, in an economy and stock market that is driven by 60 to 70% of consumer spending, you know what that means? If everyone's still spending and buying, stocks are going to be flying. And that's exactly what we've got in a V-shaped recovery off the bottom. So liar, liar. You're a liar, and I'm a liar based on the survey. We still keep buying, and that's going to help us make money in this market. Now, let's go to something that makes absolutely no sense. I think this is probably the dumbest trade I've ever heard. It's called ABUSA. Don't go there that fast, okay? If you haven't seen the headlines yet, they're coming out saying that ABUSA, Sell America, anything but the USA, that's what ABUSA stands for, is back as good old Moody's gets in a moody mood and says, hey, we're downgrading your debt. Oh, I don't know, maybe a decade later than everyone else. Let's not do that. Money managers right now, if you look at the headlines, the most bearish that they've been in 28 years. And lo and behold, in the face of this bearishness, now we're being told to abandon the USA. The era of exceptionalism is gone. It's over. You're not going to make money in U.S. stocks, not as much as you can make everywhere else. And to this, my friends, I bring up the only TikTok meme that I've ever really laughed at to give it to you straight. What is all of this? It's nothing but ABUSA. ABUSA is...
Bullshit? A bullshit? A bullshit.
That's right. That's what ABUSA is. Kids say the darndest things, and it works so perfectly this time. It is a bullshit that we sell everything American. Why, folks? I've told you the golden rule investing. Stock prices follow earnings. And if you look at U.S. stocks and earnings forecasts versus the rest of the world, guess what you see? We are still the epicenter of growth. So ABUSA is a bullshit. The worst thing you could do is get rid of all your U.S. stocks. It's called diversification. It's not diversification if you got rid of all your U.S. stocks. Am I saying that you should just be only America, America first? Absolutely not. If you've been a long-time listener, go back to the first or second episode. We talked about how dirt cheap European stocks got, how some other international emerging markets were trading at single-digit PEs. We're an advocate of buying things low and selling them high. And folks, if earnings keep going higher, so are stock prices. So don't abandon your U.S. stocks. Don't even think about it. That's the dumbest trade I've ever heard from some of the smartest people in the world. I got to second guess who they are. I can't take it. They make the headlines. They shouldn't be making the headlines. But let's end with, it's a bad bet to bet against retail. Here's another big just kind of market dynamic that you've probably heard. We're the dumb money, us retail investors, us everyday Americans, and we're pitted against the smart money. And we're really supposed to listen to these well-heeled institutional people. Oh, let's see, like a Ray Dalio, maybe a Warren Buffett. No discredit to Mr. Buffett. He's got great ideas. But they want to scare us out of stocks. I mean, Paul Tudor Jones is the most recent hedge fund guru that says stock market's going to hit a new low even after Trump cuts tariffs, even down to 50% or to 50%. Mr. Paul Tudor Jones, how's that working out for you? Not so well. We've seen the entire stock market recover all the losses after Liberation Day and then keep chugging along. If you would have just ignored all these smart money talking heads and not done a single thing, guess what? You're still up in your portfolio. If you bailed and went fully into cash, guess what? You're screwed. Yeah, you got to get back into the markets. We've talked about this. Timing the markets is not an endeavor we should ever endeavor to take on regularly. You should stay in the market. Now, raise cash, be opportunistic, but never bail in and get it fully in and out of the markets. It's a fool's errand to think you can time it appropriately. It's not just once or twice that you have to get the timing right. You got to get it right thrice, right? You got to get in, then get out, then get back in, and the cycle repeats. No one consistently can do it well. So what do we make of this smart money telling us we're just dumb money and we shouldn't be in the markets? Don't pay attention. The data always speaks. And if we look at the data and look at the performance, right? This is a rally that has happened, a historic rally in 27 days. And every smart money manager wants us to think it can't continue when here you go. Look at 25 plus years of history. It shows that these rallies do indeed continue. To be determined how far this one goes. On the backs of earnings growth, I predict it could go a lot higher. So Dumb and Dumber, not so fast. If you look at this, retail trading in the stock market has now generated is about 36% of average daily volumes. That's up from a 10-year average of 12%. So we're talking about a tripling in retail dumb money participation in the markets. Guess what? Look at the performance. If you were one of us in the month of April and we bought the dips, we're up 15%. The hedge fund smart money elite up a measly 1%. So folks, I don't want you to be ever considering that you're dumb money, that you can't be ready to handle whatever the market throws at us, because performance and having information and good information can arm you to outperform even the smart money. We've seen it happen in April. It's our goal to make sure it happens to you in the coming months. So that's this week's money rundown. Kite server, what about the downgrade of the U.S.? What will result in higher interest rates for renewals? Is the U.S. going bankrupt?
There's money in the banana stand.
Yeah, there's money in the banana stand, baby. I'm glad you brought this up. We're going to answer this later in the show when we talk about Moody. So hold that thought. We're going to get right into it. But before we do, and before we bring on our first market guest, we're going to take a word from our sponsor. Attention investors, are you looking for a high growth opportunity in the energy sector? Well, look no further than Prairie Operating Co., trading on the NASDAQ under the ticker PROP. Man, that's a tongue twister, gets me every week. As America's premier high growth, low cost oil producer, Prairie Operating is making waves in the DJ Basin in Colorado, not the Permian, but Colorado. With a recent transformative acquisition, they've expanded their footprint to 55,000 net acres and increased daily production by over 25,000 barrels of oil equivalent. Prairie Operating is poised for impressive growth, maintaining a strong balance sheet while delivering value to shareholders. Don't miss out on this exciting investment opportunity. Prairie Operating Co., PROP, on the NASDAQ. Full disclaimer, I work for Prairie, so I'm deeply conflicted. So do your own diligence and own research. Consult your financial advisor before investing. And now we're back for the B block with the guest, our first guest of the Big Skinny Show this week, Brad Thomas, adjusting the camera, my friend. Don't make yourself look taller than you already are than me. I'm the mini and the skinny. You're the tall guy. Let me brag on you for a second so everyone knows who the heck you are. Let's start with, you've written a book about Trump before it was popular to write books about Trump. You are probably the most prolific writer that's ever lived on Seeking Alpha. You probably have the most followers, the most articles, and I'll as a former contributor, I'll say high quality articles too, right? You don't just write junk and clickbait. You've been a successful investor in real estate. You've been a failed investor too. I value the fact that you're humble about some of your career stumbles, and then you're a father of 5 or 6. I can't remember.
Yeah, 5 kids.
Kids.
They're young adults now, Lou. So I don't like to call them kids anymore. They're all working and employed, so they're not kids anymore.
Listen, man, the accolades go on and on. I'm glad to have you on the show, and really want to pick your brain if you let us do that on real estate.
Yeah, no, it's great to see you again. And look, I love I love the intro, by the way. Just I fully agree, and I'd love to talk about American real estate today. I mean, obviously, my wheelhouse, my circle of competence is commercial real estate, and of course, you know me. I've been in this business for a long time, and was a developer before I became a Wall Street writer, and now at my new company, Wide Moat Research, is where you're going to find me now. I do, Lou, still write on Seeking Alpha occasionally, and I love going into chats and these types of forums and social media like this. So, well, absolutely.
Listen, hopefully,
thank you again.
Yeah, well, hopefully we have some of your faithful subscribers and viewers here. They'll chime in the conversation. Don't be afraid to ask questions. I've got one off the bat for you. I mean, you're always advocating for high quality real estate investments. Why now, though? I think they're particularly interesting now because everyone's endured so much volatility. If I remember correctly, you came up with your acronym for these REITs that you love, SWANs, right? Sleep Well at Night Investments. What are the Sleep Well at Night investments for you right now?
Well, Lou, first of all, I got to say this. I mean, my latest book was called REITs for Dummies, by the way, and I'm not going to send you a copy, Lou, because you're not a dummy. But anyway,
Ask
that's
my
I got a
wife.
lot
There
of
are times I'm a definite dummy,
yeah.
my friend.
Yeah. Well, listen, one of the things I wrote about in this book is back when I got out of college, which is a long, long time ago. When you think about commercial real estate, or when you talked about commercial real estate back then, it was basically the major food groups, apartments, and retail, and that was about it. There was not a whole lot of ways you could deploy capital into commercial real estate. But over the
Brad,
last, really,
on the fly here, we got to take a very quick break. We got to get your audio correct so everyone can hear all the wisdom you're about to share. So, folks, we're going to be right back. And while we're away, make sure you scan the QR code and sign up for our newsletter at thebigskinny.com. We will be back with you very quickly with Brad Thomas. To the Big Skinny. I'm still Lou Basenese, and you're with Lou Basenese, and we got Brad Thomas back on the line, connected better. Say something to me so I can hear you loud and clear, my friend.
All right. How's it going? Testing 1, 2, 3. Welcome back.
You're good, man. Hey, listen, let me ask you. This week we're going to get existing home sales and new home sales. What do you, when that data is coming out, like what are you looking at? Does that bother you as a long-term REIT investor? Are you keying into that for potential opportunities in residential-focused REITs, or do you just focus on something different altogether?
Yeah, so absolutely. I mean, we cover builders, but in terms of like real estate, and REITs, real estate investment trusts, we've been looking at the single-family rental market. We think that's a really attractive market, both single-family rentals, Lou, as well as manufactured housing and even apartment complexes. Obviously, there's that trade-off of the housing market slowing down, and the elevated rates has really created an opportunity for the single family rental market. So we think there's a lot more demand, in rentals. But also we're watching these numbers closely. I mean, I think there's some really interesting opportunities for home builders today. But I think the more attractive sector right now to play in is in the rental side of the game. I'm actually looking at buying some private rentals myself, just believing there's opportunity in that in that marketplace.
That's an interesting thread. I mean, you cover the home builders, right? If you look at the home builder ETF, the XHB, I mean, it's had a good run over the last 5 years, which might confuse people because, right, you haven't new home sales, existing home sales have kind of been petering out a little bit or flatlining, but I think the builders are doing a good job of controlling inventory and their pace. But what are you talking about? So single family rentals, are you doing that actually through individual purchases, or is there a publicly traded vehicle that allows people to do that very cost effectively?
Yeah, there's a couple different public REITs that just primarily came about as a result of the Great Recession. So there's 3 of them now. American Homes for Rent's kind of one of the largest out there. But back to the builders, I mean, I think the really opportunity I see is buying some of these houses from builders. A lot of builders are actually partnering now with some of the REITs to unload some of that inventory and get it into the rental market. So I think there's really a good opportunity there, but again, I think we definitely have seen some challenging time for builders. But I do think, Lou, you were right. You were spot on earlier when you talked about just consumers and, are out there spending. I mean, I still think the economy in the U.S. is relatively strong. So, I guess, I would not ignore builders. I think there's certainly going to be some opportunities going forward. Companies like Toll Brothers, which is kind of a luxury space. We like them a lot. But yeah, I fully agree with you. I think there's some opportunity there. But on the rental side, we really like that, especially, Lou. I'm here in South Carolina where I'm based, and
wait, you're not in upstate New York, man? That's not an upstate New York accent?
No. I am not. And look, I think I'm part of that migration, but I think we're seeing a lot of opportunity throughout the Sun Belt, and so that's really where we're really focused on right now in the rental side.
No, and look, I think it makes sense too, because the latest data I've seen too surprised me, right? Because after the financial crisis, the housing crash, you saw a ton of investors flood into the single home market. But it really didn't push. Right now, the current percentage of single homes owned by investors is about 15-16%. Not up dramatically from back then, I mean, where it was 10-11%. So it's not saturated with investors, I think, which the mainstream media likes to portray that, Wall Street owns all of real estate, and that's why there's a housing shortage. But when you look at this, what's the big fundamentals for you? Is it the fact that we're, 2.5 to 3 million homes short of household formation in terms of supply? Is that the real long-term driver for you in these investments?
Well, I think, really at the end of the day, I mean, we're really focused on these job numbers. I mean, I think that's really fundamental here as to whether we're going to be going into a recession or not. And right now, I think the market is relatively strong, and that's really good outlook as well for the builders. So, like you were just discussing earlier, I mean, I think we're on the same page here. I mean, earnings really drive prices, and earnings drive dividends, and dividends drive prices. So we really like to see, at least from the real estate, from the REIT angle, those companies that are able to continuously grow their earnings and dividends. And so, but yeah, housing is certainly a good indicator. But again, the consumers are pretty strong right now. We're seeing that in the retail sector as well, Lou. I mean, the shopping center and even the mall sector is doing extremely well. So, that's a pretty good indicator.
That's interesting. So I haven't looked at the REIT performance in the retail sector. What have they been doing lately? Because I think people would be, you see Walmart saying they're going to announce price hikes to cope with tariffs. We saw a couple quarters ago Target suffering from demand decrease. What's really going on in the REIT sector and retail?
Well, first of all, separate malls from shopping centers. But what's interesting, I just did some research over the weekend. The malls were the top performing property sector in the REIT space in both 2021. Malls were up 92%. Now that's the COVID bounce, right? Coming back right out of COVID, but malls were up 92%. Of course, we were long and recommended Tanger Outlets, which is in that category, and that was a great pick for us. But what's also interesting, in 2024, the malls were the top performing sector. So malls are still alive. We obviously.
It's amazing. Like, I would not think that they're still alive, right? I mean, and I have 2 teenagers, but I can't remember the last time I've been to malls and saw them thriving. But, remember the real estate crash the last time we were told malls were going to be gone, right? They're done. It's lights out, game over.
Well, we certainly saw that dislocation in COVID. And of course, we wrote about malls before COVID and predicted there was an extremely overbuilt sector. There was maybe 1,400 malls, I think we researched before COVID. And a lot of those companies filed bankruptcy. Fortunately, we didn't recommend any of those companies like Washington Prime or Pennsylvania REIT or CBL, but just sticking with the best-in-class companies like Simon. And they've done extremely well coming out of COVID. But I really like, Lou, the grocery anchored shopping center model. I was a shopping center developer myself before I became a Wall Street writer. And, this whole necessity based value proposition for shopping center REITs, companies like Regency, who has Publix as one of their top tenants, or companies like Kimco.
Man, I could use a pub sub right about now. 5:30 on a Monday, man. The little Buffalo chicken pub sub. If you don't know, you better find out. They're good, man. And you're in South Carolina, so you get them. So you like the retail sector, you like the grocery anchored. Where can people get your top recommendations? Before we let you go today, I want to make sure that everyone knows where to find you. It's at Wide Moat Research. That's where they can find
WideMoatResearch.com.
WideMoatResearch.com.
We have a Wide Moat Daily, a free daily called Wide Moat Daily. Absolutely.
Listen, I encourage everyone to pick up a copy of Brad's book, go to his website, check out his information. He knows the ins and outs of REITs and real estate investing like I do in the biotech and tech world. I would not go anywhere else for my information and investment insights there without talking to you, my friend. I hope you enjoyed your inaugural appearance on The Big Skinny. I would love to have you back again when you got some time.
Anytime. Thanks again, Lou.
All right, brother. Have a great day. All right, folks, that's Brad Thomas on the housing market. It's the biggest surprise to me is how well malls have performed coming out of COVID and in 2024. Even your humble correspondent here didn't have a clue about that. So really appreciate Brad. That's why we bring on guests. As I always said, we don't want to be douchey and act like we know everything. We want to be humble in the markets, or we're going to be humbled by the markets. So we'll talk more about that right after we pause for a break from one of our sponsors. Looking for top quality, fully custom golf polos and lightweight quarter zips? Well, Butcher Golf has you covered. Take your brand, promotion, or special event and bring it to life with full cut and sew customization starting from a blank canvas. Order as few as 25 or as many as you can imagine. Delivered to your door in, get this, 21 days or less. Butcher Golf, fully custom, really fast. Visit butchergolf.com today and mention the Sweet Lou discount for 20% off. We're back on The Big Skinny, here to talk about what lies ahead in the week, this week in the markets. It's our segment that we like to call Luigi. It's our mashup, 80s kids, 90s kids, early Nintendo players. We don't like crystal balls on Wall Street, so this is when I use my superpower to try and divine what matters in the market, to discern, based upon 2 decades of experience in the markets, what matters for you. And look, I'm going to bring it down to 2 really straightforward topics. In the last week, we talked about inflation and jobs. Those are still relevant, but we got a few Fed speakers this week, about 5, if I recall correctly, a few today and a few throughout the week. But this week really comes down to Moody's debt downgrade. So Kite Surfer brought that up in the opening block of the show. Like, what does this mean? And I think we got to see, right? Moody's is late to the game on their downgrade. They put us under a negative watch in 2023. S&P 500 and Fitch downgraded us literally years ago. So Johnny come lately, Moody's, not really a shocker in terms of them downgrading, but it is a reminder, a present reminder that the politicians, whether you are a Democrat, a Republican, an independent, an undecided, keep kicking the can down the road, and the rating agencies are not going to stand by idly saying that we're in great fiscal shape. So we have to see what's happening. We're seeing a knock-on effect in the market. You saw Treasury yields jump up, breaching 5%. I think that is a negative, obviously, right? So you're seeing investors selling their bonds to drive yields up, showing that the government is not always in control, that the man on the street, the investor, the owner of the debt, can be really influential here in driving market rates. Now, listen, if the country gets a debt downgrade, I don't think we're in jeopardy of losing global currency status because it's all relative, right? Where are you going to go? China's struggling. No one's switching to the yuan. No one can trust communists, let alone a communist currency. No one's switching to the euro because they can't even decide whether they like each other to stay together. Hello, the UK, Brexit, or whether their economic growth is even intact. But all that to say, there are foreign purchasers of U.S. Treasury markets, so they have influence. Individual purchasers in the U.S. have influence, and they're responding to this downgrade, driving prices up. So if you don't know anything about bonds, and you probably don't because they're boring as hell, right? No one likes talking about, hey, I just bought this 5% municipal coupon bond versus I just bought a crypto that it was up 5,000%. But here's all you need to know about bonds. When prices go down, yields go up. So if yields are going up, that means people are selling. They're selling the bonds, which drives prices down when people sell because they're just get it ready to liquid, and that drives prices up. But then this drives borrowing costs up for the rest of the economy. So not good news. I think 5% is a key threshold here. I think you're going to have to see some intervention, and I don't mean from the Fed. Here's what I mean. If you look at all the ratings downgrades, and you're going to have to see how we can follow through on this, there's uncertainty that the U.S. economy can grow faster to pick up some of the slack on the deficit, right? So everyone is insisting that it all come via spending cuts. I think they're downplaying the opportunity to grow the economy much faster. So back half of the year, that could look like more growth coming from tax cuts. Back half of the year, that's earnings growth. You're seeing the estimates for U.S. corporations. This quarter, they were expected to make 6% profit gains. It's actually 12%. So there is upside surprise in the underlying strength of the economy. So we got to be paying attention to mood swings in the market. What happens? Yes, the government got downgraded, but what's that mean for corporates, other forms of borrowing, mortgage rates, right? Mortgage rates are going to go higher. That's going to be a damper. The next thing we have to worry about, and this is why I had Brad on, is the data this week on real estate, existing and new home sales. So we get existing home sales on Thursday. Friday, we're in a chronic shortage. This is what you need to understand here. You see new and existing home sales they're below average, and this is two factors. One, affordability. They're not affordable at all. I think this has been the least affordable time to purchase real estate, with mortgage rates at 7% and the median home price north of $420,000. That's a huge jump in the last 15 to 16 years from a median home price of $235,000. So got to be paying attention. As I mentioned, home builders, if you look at the ETF there that trades the home builders, they've done pretty well because home builders have managed inventory. They've got a lot of permits, but here's the key. Chronic shortage. You don't have to recognize anything from this chart except for the far right and looking at the negative almost 2.5 million homes that we're short. So no matter how many homes are sold, we still need to build a lot more. This is more than 2 years worth of building, I believe. Again, I could be off base because I don't have the data in front of me. But that's the key driver this week. Are new home sales and existing home sales picking up? Are they flatlining? As Brad pointed out, look, the consumer's in a good spot. They can afford to buy housing, but the prices just aren't attractive. Another data point to hold on to for all you people that are worried that you haven't bought your first home yet. The median age of a first-time home buyer has now jumped to 38 years old. So huge increase from just only a decade ago. So you're seeing affordability really drive this market. We got to see prices come down, and that can come from one or two ways, separately or together. Mortgage rates or actually home prices coming down. Action Jackson saying the algos bought every dip today. Do you think the big boys are taking us higher? I think the big boys have some catch up to do. After a meager 1% return for most hedge funds in April, they were bailing in mass. If you looked at equity flows and selling from institutions in April, they just ran for the exits. Sell first, ask questions later. So they're trying to play catch up. So yes, to your point, I do think that institutions are coming back into this market. There's a lot of cash sitting on the sideline. I think they were in risk management mode, making sure what they owned wasn't going to implode. They've done those channel checks, those risk checks, so they're coming back. That's a reminder, everyone, don't fall for the smart money moves. You see the smart money, quote unquote, going in and out of the market. That's the worst thing that we can do as individual investors. It's time in the market that matters. If you try and be a trader that is trying to always get an edge on every day in and day out in the market, one, you're going to drive yourself crazy, and two, you're going to drive your wealth in the wrong direction. Reminder two, join the conversation here. We're open for comments, questions. I can't give you personalized investment advice, but I can give you generalized advice or specific comments about a specific stock. So don't be afraid to ask, chime in, and make sure you're signed up for our newsletter at thebigskinny.com. You can scan the QR code on the screen or go to thebigskinny.com, where we give you in our newsletter actionable insights in one headline, one chart, and one action to take. We'll be right back after another word from one of our sponsors. Business moves fast, and so does search, especially now with AI transforming how customers find you online. If your business isn't optimized for AI-driven search, you're missing opportunities every day. Incend Media is more than marketing. They're strategic growth partners using advanced answer engine optimization, cutting-edge SEO strategies, and proven business analytics to help your company generate new leads, attract more customers, and solidify your brand's presence. In the era of AI, visibility equals profitability, and Incend will ensure your business stays ahead. Visit incendmedia.com today, and don't forget to mention the Big Skinny to get your free SEO performance audit. With Incend Media, your growth is just a click away. Welcome back to the Big Skinny with Lou Basenese. The man on your screen now was the man just on your screen, big and skinny before, man. You know, maybe we should do a fact check here. Take off your shirt. Let's see if you got the abs, dude.
I don't think so, man. That's not gonna happen.
All right.
Never.
Well, it was worth. They bet me to do it. So here we are. We're back with the Dodd block. He's still got his Dos Equis, Cinco de Mayo leftovers to talk through what matters most. Yeah, man. So you're here. I think what I always value about you, and so do our viewers, is when I get out of line and talk in too specific a terms, finance and stuff, you go, hey, man, that didn't make sense. Can you explain it to me? And that's what we always want to be. We want to be understandable. That's right. Understandable and actionable. So, yeah, ding, ding, ding. I'm not understandable
a little
today.
extra tongue-tied today, Lou.
Dude, I don't know.
Maybe that's
man.
because you didn't crack your beer earlier.
Yeah, maybe that's just because there was so much drama in the markets with telling people to sell everything they own in the USA. That's just the dumbest advice I've ever heard. But I mean, they're on it. He's got it.
Hey, first of all, Lou, I'll jump in, man. I have to say that, I noticed and I appreciated you opened the show a little different today.
I did.
But
switching it up. I was kind and gentle to the UCF fans in our crowd here.
But now I feel guilty. So what's wrong with me?
I don't know. We don't have enough time in our show, my friend, to get into that. But what are we talking about today? This is the time of the show where we run down the high five, where we keep ourselves accountable. We either high five ourselves for getting it right or high five and fail for getting it wrong.
No.
We're going to find out who is it.
Maybe both.
Well, what's on the rundown for this week on the high five?
Oh, let's see. We have inflated egos. I'm guessing that Taylor's bossing you around over there because he calls one options pick last week, and now he wants his name on the door. That's what this is about.
He's not
Get in
there
line,
yet.
man.
He needs another successful trade for, two. One is a fluke, two starts looking like a trend, three, and you're in the money. But no, inflated egos. This was the most surprising data that I've seen in a really long time. It gets into inflation expectations versus reality. And look, I don't need to be political, right? As a businessman, as an investor, I need to learn how to thrive, whether there's a Democrat or a Republican in the White House. But this just makes no sense if you look at the data right now. Inflation expectations, if you break it down by Democrats, soared to almost 9% in the most recent survey. I mean, it just doesn't make any sense. That's like almost 5 times the current level of inflation. So I'm here to tell people, right, lose the ego about politics and look at the markets with just an unbiased view. Look at the data. Don't let your politics come in, whatever side you're on, because it can really influence your judgment. And if we took this data of where people expect inflation to be based upon their political leaning and then matched it up with reality, it doesn't ever match up, right? So you're just out of touch at a time, and usually hurting your bottom line instead of helping it. So that's what's got going on with inflated egos. Don't have one. It'll only hurt you in these markets, not help you.
I was a little off on that one, wasn't I?
You are a little bit. I mean, Taylor's not in here, so I didn't want to give him a hard time without him being here to defend himself. So
let's see. This old house. Reminded Bob Vila. Love Bob Vila.
Bob Vila, man. He's just that grandfather you wish you had that you didn't, right? Like always around, just projects going on, knows something about woodworking.
Did you know that he never intended to start a huge decade-long run as a TV host?
Come on.
He was really just promoting his contractor business.
No way.
Yep, that's a fact. But
So that
that kind of makes me feel like I have some promise here, interning for the big skinny.
Oh, yeah, we got to have a word about that at the end of the show. It's a send-off, my friend. Sorry, your internship's over. Bob Vila then is the first reality TV star. Like, he created it, right? He just filming himself doing what he was doing. All right, no, this old house has nothing to do with Bob Vila. It has to do with the old age of the median homeowner right now. The median age of all home buyers is now 56 years old, up from 31 in 1981. Think about this. There's a direct correlation to home prices. We talked about the average age of the first-time home buyers now at 38 years old. Now the median age of all home buyers, 56 years old. There's a great data out from Torsten Slok over at Apollo. If people aren't following Torsten Slok and Apollo Management, he sends out basically a chart a day that should be just kind of part of your daily diet for the markets. It's always instructive, maybe 25 words explaining it, self-evident, but really good data that keeps you level set and helps you read through the misleading information in the headlines.
All right. Well, see, crypto crazies. I smell a sequel to Is This Crypto or Crap? Is this what you're trying to tell me? You're looking for a replay?
I'm not looking for a replay of that, but this is where I really struggle. Remember, we had Anthony Pompliano on who, came out today to let us know he's got an AI agent for your personal CFO that tells you how wealthy he is.
What do you think about that?
Our manifesto is don't be a douche. So we're not going to be douchey. We're going to be humble. So I'm not going to say anything about that. But I will say this. I'm struggling. Anthony did a great job to get me onto the side of there's two camps for crypto, right? There's the speculators. And then there's the investors that look at it as a way deferred savings, kind of like your checking versus savings account. The functionality of crypto, the fact that you have so many companies, publicly traded companies now that are acting as buyers of crypto to be holders of it. But here's what
he had you moving in that direction, right?
He did. But here's what troubles me, right? Wall Street Journal headline, severed fingers and wrench attacks rattle the crypto elite. You're becoming targets, right? Because everyone knows whether you're a crypto millionaire or billionaire. And now you're literally seeing gang violence to try and get your crypto wrestled out of your hands. I mean, folks, this is not the signs of something that's going to be adopted mainstream by Main Street America. Right now, we can get into the whole Ozark conversation that money laundering happens and the rich are always being fleeced and targeted, blah, 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 blah. but this is not good PR for crypto as far as I'm concerned. It's a bit crazy, and if I had an extra 18 million sitting around just plunk into something, I don't think I'd buy crypto now, knowing it could make me a target. So not that I have anywhere near 18 million sitting around, to be clear. So I think I
more like 17, right?
Yeah, 17 cents in euros. So anyway, crypto crazies. Don't be one of them. I think you should. It's like gold, silver, precious metals, alternatives. 5% allocation maybe to these things in aggregate makes sense. If you go all in with your portfolio on cryptos, prepare to go all out of money if it doesn't go well for you, either from thugs, criminals, or just the market.
Well, I hear you, man. So let's see. What's next? Baby bankruptcy bump. Say that 5 times real fast.
Baby bankruptcy bump.
Buggy bumpers. I mean, I think, I like on this one because I actually know what I believe I know what this one is. And I'd like to make a call to our sponsors. Any sponsors out there, give us, drop us a line because we don't want to be another stat on this line.
Yeah, look, you got good instincts here, man. There's a spike in bankruptcies, but I want to caution people about reading too much into it, because this is going to be a headline that becomes much louder in the coming months. The result of tariffs, so many small businesses went out of business. These bankruptcies are spiking. Not invalid, right? But I want to put it in perspective here. So we have a chart that shows the relative number of bankruptcies kind of by year. And you see year to date now we're at 246. So that's up relative for U.S. bankruptcy filings by year. But the rest of the year, we still got a long ways to go until we're
only through April.
Yeah, we're only through April. But look, you got to that's kind of the norm, anywhere from 500-600 a year. We're still kind of on track with that. When you start ticking into the 4-digit bankruptcies, that's when I get worried. There's something fundamentally wrong with the economy. We're not there right now. You're getting tax cuts. They're coming. Moody's is pushing that. So baby bankruptcy bump, don't read into it. There's no baby bumps here. There's no bankruptcy anything more than a bump. I don't think it's going to be a catastrophe like people want you to believe.
All right. Let's see. Believe the hyperscaler hype.
Say that
I'm sure
5 times.
Yeah, that's another tongue twister.
No, this is one of those things. There's hype, but you should believe it. And here's the data to back it up. I mean, we always have data-driven insights here. We've talked about AI spending. I've shown it mostly from the Mag 7 perspective, but this chart, this data, it looks at the CapEx expenditures and throws in Cisco in there as well. It's a really easy chart to read, so easy a 5th grader can see it. Maybe my 11-month-old son could point out the trend here. It's just up and to the right. Hyperscalers are scaling in a massive way. So don't not believe the hype here. You got to believe the hype in terms of hyperscalers. So jump into the conversation. Here we are. Hyperscalers going to hyperscale. Year-over-year change in CapEx estimates. Like I said, throwing Oracle in here for the last 12, 13-week average. Since the beginning of the year, these big tech companies have only been increasing planned expenditures to build out AI, and that means one thing. They're going to be buying more chips and deploying more AI, which is going to drive the whole ecosystem and keep that narrative and that bull market alive. So don't forget, we are live on multiple platforms. Make a comment, make yourself heard. Can't you be a target even if you are not a crypto person? Yeah, I think you can be a target, but this is also why, I think it pays not to be flashy, right? Understated wealth is admirable. I think some of the most respectable people I've been around, you'd never know how successful they are, but that's not what's popular in today's day and age. You get influencers that I don't even know what they influence, but they make a lot of money and they drive McLarens and they crash them into walls and they cry on social media and they make more money. Yeah, probably don't be that guy, but yes, you can be a target no matter who you are. I think it's an admonition to be humble and low key. So that's my goal. I'm practicing before all the wealth is there, being low key, Dodd.
Well, that's good, man. It's good being humble.
Yeah. What happened to Q on the agenda statement from last week? Remember how we said we don't like to give out insider information? Well, sometimes I come in possession of material non-public information, which is okay to have that information. It's just not okay to trade on it or share it. There's a few things that I want to make sure that I'm clear of and can share. But you did see Q Biopharma report their quarterly results, talk about the Q400 series, the 500 series. They announced a strategic partnership. Also talking about the data maturing for the 100 series, which is really unique in nasty head and neck cancers. They're seeing a strong survivorship for those patients. And look, I mean, Dodd, you and I have talked about this full transparency, being humble. This is a stock pick that ran up really early for us, and we probably wish we both sold. We've held on because the science is really good. So I do believe, like we saw with Prevention Bio, that the data will prevail in the end. The data is still tracking well. We'll have more updates on Q as we can share them in the coming weeks.
Hopefully, really, man.
Yeah, 2 health stocks took big hits last week. UNH, won't touch it with your money, Dodd, and Eli Lilly. My thoughts? Look, I love Eli Lilly like I love Apple. I think Eli Lilly, for those of you that aren't aware, are one of the 2 major makers of blockbuster drugs for obesity and weight loss. You probably get confused between all the names between Ozempic and Wegovy and Mounjaro and Zepbound. Dodd, do you know which ones are which? Who sells which ones? Don't go to Google.
Don't know.
Yeah, so it's easy. Novo, Ozempic, and Wegovy. Those go together. Eli Lilly is Zepbound and Mounjaro. Here's where the key is. Why do Novo Nordisk took a hit too, right? Why do I like Eli Lilly over Novo Nordisk? I think Eli Lilly is the next $1 trillion company, and it comes down to their science, right? The scientific name for Eli Lilly's drug is tirzepatide. Novo Nordisk is semaglutide. The difference is tirzepatide targets 2 receptors and has stronger results in terms of helping with obesity and diabetes and all the other things that have yet to come down the pipe in terms of improved health benefits. So because Novo's drug only targets 1, it's going to have less of an impact over time. I think Eli Lilly in a 2-horse race wins this race hands down. Light Video, 23andMe just got acquired for $256 million after filing from bankruptcy. Can I get some of that if I file too? I think you got to get in line, file your claim, see what happens. Bankruptcy's up. I know this was a good outcome. If anyone's been following the headlines here, Regeneron acquired 23andMe. Dodd, did you ever take one of their tests to find out that you were 0% Italian?
No, never took one. I think my wife did though.
Yeah, I took one. It didn't show any surprises. They told me, pretty much 25% Irish, 25% Scottish, 48.2% Italian, and then a little bit of Northern Africa influence. And then over time, that just disappeared. So my ability to dance declined too. That's what was what I was staking it on. That's why I had a beat and a rhythm. But now I'm just an old white guy dad that can't dance. Hey, I told you I'd be transparent. I can't. Back in the day. Maybe.
Just don't try, man. Don't get out on that dance floor.
I'm not going to do it. You're never going to see it. So 23andMe, a good outcome because there was a lot of talk about China or some other unfavorable party coming into possession of that data. Hey, join the conversation anytime, all show long. You can interrupt us, change the adventure that we're having. We always welcome it here, so don't be shy. Dodd, I'm going to go to you for any closing thoughts as we wrap up our 10th episode of the Big Skinny. Highlights, lowlights.
Yeah, overall, man, I think, I pulled that the Lou Basenese sentiment meter that I have is pretty positive. I think you've been bullish on the idea that, we're not going to go into a recession. And, the beginning of the show, I think, several things are telling me that's what you're feeling. That's true, right? It
is true. And look, we've been a dissenting voice out there, and I want to always be that, but always be data driven. So I think it's important for people to understand. Look, the Big Skinny is not about regurgitating what's in the news already. It's about deciphering what you shouldn't be regurgitating and deciphering what actually matters. And that's what we're going to endeavor to do. We're 10 episodes in. We're going to 100 next and 1,000 after that. And look, I'm going to promise you this. We're going to iterate and innovate along the way. We want to hear from you. What can we do better? How can we serve you better? Are you young and new to these markets? Are you old and fed up in these markets? Are you old and young and broke and looking for a new way to get ahead? Or are you just looking for a different voice to give you some guidance? We want to know. So hit us up at info@thebigskinny.com. Or even better, join our next show. We're going to take a break for Memorial Day, and then we'll be back right after that. But join our list, the newsletter at thebigskinny.com, or scan the QR code on the screen. I'm Lou Basenese. That's Dodd. I have never revealed your last name on air. I won't do it. I'll protect your privacy, my friend, because you could be a target too. Don't just let me be the target. Thanks as always. Thank you for tuning in. I'm Lou Basenese, signing off.
See you, Lou.
See you, buddy.